Our next call is John from Brisbane. Welcome to the program, John.
Yeah, good evening. How are you?
Good, mate. What can we do for you?
I'd just like the panel's opinion. I've got a self-managed super fund, and I was thinking about buying some AGL shares to put in there.
Yep.
And also, I've got quite a few shares in Horizon, which was formerly Queensland Rail, and I just want, is the panel, it suggests to hold or sell?
Yep. Horizon. Okay.
It was the first one, AGL.
AGL, yeah. Yeah, what do you know?
Well, AGL, from our point of view, it's capped at about $8.5 billion, John. Return on equity of about 7.5%, which is not particularly exciting, but it's something you'd expect for a little bit of an infrastructure type play. Debt to equity of about 38%. Our valuation is considerably less than the current share price, so we would let that one through to the keeper.
Our first caller after the break is an old faithful, Abe. Welcome to the program, Abe.
Thank you, Kim, for taking my call. I just have a general question for the panel regarding iron ore stocks and energy stocks. I mean, things like BHP and Rio, they're paying 4.5% franking. Hello?
Yeah, we can hear it. Still here.
Yes, and WPL are paying 6% if you include the franking. Why is it that people are so frightened to invest in those stocks and they're so much underperforming the health stocks, for instance?
A good question. I think that's all about where the market perceives value at the end of the day, and Mr. Buckland.
Oh, I think in simple terms, the Chinese economy is trying to move from an energy-hungry economy, Abe, to a consumer-led economy. There's obviously a lot of very, very large players in the iron ore industry. BHP, Rio, Vale, Fortescue, they're all expanding their production. And as you well know, it was this time only last year that the iron ore price got down to sub $90 a tonne. It's since bounced. It's currently around about $130 a tonne, but there is a fear over the medium term, and I'm not saying it's actually going to happen, but there is a fear that one day that iron ore will return back towards $100 a tonne, in which case BHP, Rio, etc., will struggle to demonstrate earnings growth. Just to give an example, BHP's return on equity 5-6 years ago was 45%. Its return on equity today is 18%. Its indebtedness is about $15 billion higher than it was 5 years ago. So these are fundamentals that are not the sort of most exciting, and you can find many good quality industrial stocks that have gone up by factors over the last 5 or 6 years that have increasing ROEs rather than decreasing, and improved balance sheets rather than deteriorating balance sheets. You
could say though that BHP, like Rio, has had that big capex build out, and we're now starting to see the benefit of that as the capex runs off, and we've got the production outputs coming through and earnings improving.
There is no doubt about, with the sea change at the CEO level of both companies, the boards have now basically whipped these guys into shape and said you've got to justify every last cent you now spend, and we have to have a much improved return on equity focus, and we have to make our assets sweat, and that's definitely going to occur. And if that's the case, it'll then just come down to the underlying commodity prices. Yeah. If the commodity prices are kind, they'll do okay. If they're unkind, they won't.
It's time for another stock watch. David, you have 30 seconds to give us a stock you've been watching and why. And your time starts after the sting, which will be... We're waiting. And now.
Thank you, Kim. The stock I quite like is called G8 Education. Its ASX code is GEM. Despite the fact that it's moved up from approximately $1 to approximately $3 in the last 12 months, we think it could be worth as much as $4. It's got very disciplined management. It's got return on equity that it should head up from about 12% towards 20% over the next 2 to 3 years. It's got very low debt to equity, and it's got extremely disciplined acquisition roll-up abilities.
Our next call is Jeanette from Brisbane. Welcome to the program, Jeanette.
Yes, hello guys.
Hi.
I know you've had a lot of calls on MMS, McMillan Shakespeare.
Mm-hmm.
So I just wanted to put my input into it. Since the 16th of July to the 7th of September with the elections, Abbott sent a letter to MMS saying he won't change the FPT tax on novated leases. So that's only 7 weeks that affected new contracts, which I'm sure they are moving to get back. While the 3-year leases haven't been affected, or salary packaging, I know it's been heavily traded, but what do you guys think about the stock fundamentally? And I know there is a report coming out on how they're going on the 22nd of July, so I'd just like to have a little bit more input from the panel, please.
Okay, McMillan's probably, I think what I've read on it sort of suggests $14-15 a share.
Well, Jeanette, we're a serious shareholder in McMillan Shakespeare, and I'll just explain the situation. On our blog, rogermontgomery.com, my colleague Tim Kelly wrote a 3-piece article, and our assessment was that, put simply, is that if Rudd changed the fringe benefits tax, which we viewed as a 20% chance, it was worth $5 only. If everything was unchanged, it was worth approximately $14. So our risk-adjusted view on it was worth about $13. When it came out of suspension pre the election, it traded down as low as $7, and we went very hard on it at $7. It's since traded up as high as 13 and since come back to the low 11s. At $13 odd, I think the easy fruit has been picked, particularly from the rally from 7. And the reason I say that is that this half year's earnings will be dramatically affected by the fact that it spent about 2 months of this half year earning basically nothing. The entire industry just packed down for about 2 months. So I would say that this half year's earnings will be negligible, and then it'll start earning serious money from next half year. That said, our view on it is it's a $14 stock. So if it gets down to low 11s, we'd be very comfortable buyers again.
Well, let's move on. Our next caller is Peter from Grange in South Australia. Welcome to the program, Peter.
Thanks, Ken, and to the panel. I've got a question for David. I'm just wondering whether the Montgomery Fund use a stop loss if they pick a stock and it trades below its intrinsic value. That's question one. And question two, I guess for David and for the panel, an entry point for Magellan Fund, and do they still think there's growth in the stock? Because I've got my own intrinsic value, so I'd be interested in their thoughts.
So, do you use a stop loss?
The answer is we do not use a stop loss. What we do is we sell if the fundamentals of a business deteriorate or management basically becomes distrustful, or there's some sort of proposition that comes along that we didn't see, or finally there's better prospects available. That's when we basically sell a stock. On the subject of Magellan Financial Group, that they've had an absolute purple patch. Raising, I think they're now up to about $17 billion of funds, and in fact in the month of August I think they raised $800 million alone in that 1 month. So they're up to about $17 billion of funds. At the prevailing share price, we can't make it stack up financially. However, if they go from $17 billion to, for example, $30 billion, then I think the current share price is just about viable, but you need to have some fairly heroic assumptions for that to occur. And we all know with these fund management businesses, and we've seen, I discussed Platinum Asset Management a little earlier, they can go through very good times and they can go through very bad times. And you only need a bit of a bear market or a strongly rising Australian dollar or a loss of love affair with the big global blue chip brands that they tend to own, and suddenly the gloss is going to come off the story a little bit. So I would be very, very disciplined in buying that one, and for us at the prevailing price, it's just too expensive.
Okay, it's time for a viewer email, and Jeffrey writes, good evening panel. What do you think of the medium to long-term prospects of M2 Telecommunications Limited? I've been a shareholder for about 2 years and would like to continue to hold the company as it continues to grow in the coming NBN environment and reduces its debt. What are your thoughts? Regards, Jeffrey. Okay, this has been a pretty hot sector because we had TPG reporting this week, and that's come out of the starting gates with an absolute boom. But first, your thoughts, Dave?
Well, this is one that we've been a long-term shareholder of, Kim, and it's performed absolutely superbly. Vaughan Bowen, the founder of the business, and now Jeff Horth, who's the current managing director, have done a great job with this company. It's risen from originally floated at 25 cents, I think about 7 or 8 years ago. It's hit a high of $7. It's paid a factor of that 25 cents back in dividends to the shareholders. My only issue now, Kim, is it's been a very strong roll-up story, and it's made 2 very large acquisitions in the last 17 months. And its net debt to equity now is about 93 percentage points. And that to me is something to be quite wary of. I would prefer probably something like TPG, simply because its balance sheet is in so much better condition. So I'd probably, I think there's better opportunities just simply on things like balance sheet prospects.
Let me just pose the question to you both. Is this the time, given what that performance we saw out of TPG, is this the time to actually start taking some off the top in Telstra and start to allocate some of your funds to these second-tier growth stocks?
I would. I think these second-tier stocks have outperformed Telstra by many factors.
Yep.
So I think it's been a no-brainer to be in these second-tier stocks ahead of Telstra.
Still a no-brainer?
Absolutely the case, except I just make the point that with them too, its indebtedness is high, whereas the others are far more attractive.
Hef?